This is Justin Pulitzer. This is my weekend review for Sunday, October 25th, 2015, although you may be seeing this early because I'm going to be posting it a little bit earlier than usual. Anyhow, we'll jump right in. There's a staggering amount to cover here. I hope I can get through it all. I had discussed with regard to the market that there are 6 keys to the move, and those are the VIX, the dollar, the bonds, oil, China, and biotech. And as you can see, the VIX has been in a pattern here of lower highs and lower lows. I had thought we would bottom out here around the mid-14s. We even pressed a little bit lower into the 13s, but volatility has been coming in. I do believe that mid-range here may catch it. I don't know if we're going to fully get down to the 11s and 12s, but you can see we're getting pretty bombed out here in terms of the stochastics, and I am expecting some type of an upturn to the downtrend line at some point. But VIX has been going down, and I believe that is why the market has been, partially why the market's been rallying. The dollar is kind of a bit of a conundrum here. I've been talking about this being a major danger, sort of stranger danger, right? But major danger for the market. And last week I had said that we did break down. We made some lower lows off some lower highs, but we've rallied back up. China is easing and Europe is easing, and the Fed is going to kind of have to follow suit, because if this dollar breaks out and fills up the triangle up here to the 26s, that's going to get kind of pretty ugly for the market. I've talked about several times that the market, that a lot of companies have foreign earnings, and the further this goes, the weaker those earnings are going to be. The quality of those earnings, the dollar, the pressure has been mentioned in a lot of earnings reports, most notably Facebook. It's been a concern for Apple, and this is really right up against the trend resistance. So if this breaks, there could be some real trouble in store for the market, and notice how these things are starting to coincide a little bit. Anyhow, that's the dollar. The bonds are doing a good thing here. You can see that we are, if you go back further, this was the 2009 crash high, and consolidation above there is good for the tape. If yields stay low, PE multiples and prices for stocks should stay high. If the bonds start really falling out of bed, that could get a little bit more iffy, as there's yield competition. It's sort of if you're getting a higher yield, you'll take less risk. So bonds are kind of just hanging out. This is okay. They don't even really need to rally, just as long as they're not falling out of bed. That's acceptable. The oil, however, did kind of fall a little bit out of bed here, although it really is just to the low end of the range here. If you take a look, we got up to the reference high. We're pulling back. It's really just down to these lows. I don't know that we're going to make new lows in oil, but I do think that it's sort of going to take some time before it can go higher. I do think that the risk is to the upside, but this is kind of looking like it wants to form a bit of an ugly kind of bottom. Anyhow, this is sort of a bull flag within inside of a bearish pattern, but I do believe oil is trying to bottom, but it is going to be kind of ugly. I had talked about Exxon, and you can see that it's been in a protracted downtrend for a while, and the real breakdown started here with the earnings from 83, and it just completely fell out of bed. And now it's come really right back up there. You have a 200-day moving average. This was really the breakdown level, you can see. And I'll show you. This is pretty remarkable price action. We came back up, fell down a little bit here. I actually was still long. I guess I was being a little bit greedy. And it fell down, and I was thinking about stopping out here. You can see the low of day here was 80.20. And the close here was 80.21. And that kind of kept me in the trade. Anything below this 2-day low, I would have been out. But luckily, or skillfully. The next day was this really big kind of Maribozu type style candle where there was a gap and go. It closed above the downtrend line. Today, bit of a pullback, touched the downtrend, and then rallied back up and closed pretty strong. So if this can break through the 83s, I think we can possibly even see 85s and maybe even 86s. That's sort of like where the real profile, the volume profile, starts picking up. And that had been a significant level in the past, although this chart doesn't really show it as well. You should see here that these lows roughly were around the 86 levels. So that, to me, that's why it's important. We are coming up into a little resistance. It's been multi-day rally, although you can see there was just a few days pullback, and then it took it really back. This is almost this kind of shuts off the sellers and puts the bulls back in charge. So anything over these 2-day highs, I think, can still run. But it's a little strange with oil pulling back. China, bullish. I've been saying that I was getting a little bit more cautious coming up to the channel, but we are now back into that area that I had discussed where the breakdown was. I think in the last week video, I had discussed these mid-40s. We're getting there, so a little bit more cautious. Although there is some, and we're also getting a little bit, I wouldn't say euphoric, but we're getting a little bit high on the stochastics. You can see where they've topped out before. So I'd be looking to maybe book a little bit of profits in some of this FXI if you've been long. I'd be looking for a retest maybe of these 37s, maybe 38 for a buy the dip type of a scenario. If it kind of breaks out and then checks back, that to me would be interesting. Some of the stuff that's been kind of cool with this has been BABA. You can see we kind of double bottomed here, was slightly lower, and then it's just rallied up. There was some resistance on this downtrend line. And then today, look at this. We have closed over the primary downtrend. This was like a gap and go. Almost a mini professional gap. I'll show you a really amazing example of a professional gap right after this in the terms of eBay. But this could be this is for sure a change in the price action of BABA. My only concern, though, is look where we're coming into the real breakdown, and look where the volume profile picks up. These are all the people who've been kind of sitting patiently, hoping and praying that BABA kind of came back. And I think that there's going to be a lot of resistance within this band here between sort of the breakdown here of the 83s and 77s. So if you're playing long, you might want to start to look to lighten up into here, or if you want to start maybe even initiating a short for some type of a pullback, this area to me is probably where it's going to go. We have earnings coming up, so if there's a gap, it could be one to sell into. If there's some weakness, it might be worthwhile trying to maybe play a little bit of a long on a pullback. I do believe that this confluence of the 50 and the 20 could be an interesting area for a right or right out play if there's some type of weakness. One I don't talk about or I used to talk about, but I haven't recently, is this BIDU. And the pattern here is starting to actually look a lot better. It's been in a protracted downtrend. I drew two channels in. One is sort of the regular channel, and then one was a little bit more of an extreme channel. But if you take a look, this is almost like a cup and handle pattern, or an inverse. I don't even want to say maybe a little bit of an inverse head and shoulders. You got the kind of the left shoulder, the head, and then the right shoulder here. And then this was the neckline, the 153.76, and we broke out here. It didn't do it with a ton of conviction, but maybe this wants to traverse and get up to try to start filling some of these gaps. I would say that this pattern to me looks a little bit more bullish. Obviously, earnings could tank it, but I mean, given Google's strength and some of the other search strength, this to me looks like it may want to have a little bit more of a run, maybe up into some of these reference areas. So we'll see how that goes. But BIDU is looking to me like it looks like it wants to turn here. So this has been the real crux of the matter in here with this IBB. And I had talked about this being a head and shoulders top, a check back. It failed, it broke down, it did hold right basically on trend and also with these reference lows, although it has been really a rather weak bounce, and it's really been forming this sort of bear flag. It is possible that there is some type of a test of the primary downtrend line in the backside of the secondary uptrend. You can see how I drew that in. The green is the primary and the yellow is the secondary. So that confluence here to me would be an amazing right or right out short. But I think what's been driving this has been sort of the opposite of how the market is supposed to work. It's sort of like the tail wagging the dog and art, or I should say life imitating art, not art imitating life. But I think a lot of people have been piled into this ETF, and it's been hurting the stocks, as crazy as that sounds. Not the stocks hurting the ETF, but the ETF hurting the stocks in many examples. One thing that made me think that this might be kind of trying to turn the corner was Biogen had good earnings. This is really what set it off, this blow off top. Take a look at this kind of dragonfly doji up at the top of the range. We'll discuss that when we talk about Facebook. But you can see that this really fell out of bed, and I thought this could maybe end the pattern, but it's been still really relatively weak. I'm a little upset about Gilead. That rallied on AbbVie. They had some Hep C issues. I was thinking about playing this long for earnings. This kind of blew my play. It is kind of peaking up above a downtrend line. There is a little bit more room, but also kind of been a little bit relatively weak. I've been looking for a retest down here where the major breakout was, closer to 84, 85. We haven't gotten that. We had a higher low here, so maybe this just wants to kind of zoom up and retest the highs. Gilead, I think, is kind of the best of breed when it comes to these types of stocks, although I'm a little bit... I don't like buying when things have run up, although that worked really well for Google and Amazon, and I'll talk about those a little bit later. But yeah, the Gilead has been weak, and it's trying to rally. I think one of the real culprits has been this Valiant. This had a head and shoulders top. If you ignore technicals and neckline snaps on head and shoulders, this is kind of what happens to you. Although I will demonstrate how longer-term patterns and trends come into play more often than you would think. So look at this primary trend from all the way down here, and look basically to the tick where this stopped on a 78.6 Fibonacci retracement and the primary trend. There is a secondary trend line here. This snapped pretty quickly. 106 was an important level. That did bounce initially, but it came back down. On the daily, we all know that Citron Research came out on this thing and said it was basically an Enron fraud type of a stock. You have a higher low here in terms of a hammer. They have a conference call on Monday, so there might be some continued squeeze higher. I don't like to mess around with these patterns on stocks like this because I don't know. I don't have an edge on this other than the chart. However, down here, the risk reward to me was a lot more compelling than it was maybe up here, trying to play for a hold. So if there is no fraud here, the lows should be in, considering you have two large hammers, and this low was higher than this one. It is a little concerning, though, that we aren't back above this close. That's sort of the, I don't know, I would say the fly in the ointment, maybe. You can see that it looked into that bar and then kind of failed. So you really want to see some acceptance above the 118.61 close for this thing to really get going. But we'll see. That this is to me going to be important. You've had a lot of these sort of hedge fund hotels. Bill Ackman has been in this one. There are some other large funds that are in them. And you've had a lot of these like sort of hedge fund stocks blow up. The same thing with this Sun Edison. This thing absolutely imploded on itself. Skechers kind of imploded. Look at this, down 30%. I'm looking for a primary trend touch or maybe even a gap fill down here. I'd like to be selling some either 25 or 21 puts. This was sort of a major breakout from for a longer term. This may want to bounce a little bit and then roll over. I don't know. There were a lot of people who were asking me today, was this the buy? I tend to not like to buy on the first day. I get a little bit iffy with these types of moves. I'd like to see it confirm, maybe above this high you could play for a day trade. But I would be more interested if this thing came a little bit lower. I was looking at the puts maybe to sell some premium here, but amazingly enough, there really wasn't that much premium down here. So maybe the low is in. I don't know. If it breaks this low a day, though, you want to be GTFO or even play short because there will be a lot of continuation. So I would say on Monday, you could either play long over the high of day here, which is this 33.53, or short below the 29.55, probably for some continuation down closer to the 25s or 26s. Another big stock, that collapsed was this Walmart. Look at this. This has been a ski slope down. However, on a longer time frame, this next move down might be the last move down. Hold on. At least for a while. Let's see, 10 years weekly. Yeah, you can see from back from the 42s, it broke this sort of second, or it's breaking this secondary trend, and then the primary trend is down here in the 55s. This is was a 54.55 was a key level I have marked off. 52 is the 61.8. So somewhere down in these mid to low 50s, I do think that there's going to be some muscle memory and some buyers. I would probably be interested in selling some out of the money puts or at the money puts as a long proxy in Walmart. Target, the same kind of thing. This is just looks like it's first starting to break down. This almost looks like a head and shoulders that's on an angle. This could easily break down to test, this secondary trend, or maybe even implode and test the primary trend from down here. That really the channel low, it kind of broke out. It was unsustainable. Maybe it wants to come back down. But these stocks are looking, this area here, this 70 area. It may check back. That's going to be key. If it can't hold there, maybe if it comes and checks back, it bounces. But if it breaks here, just get out. This thing is going to get pretty ugly. I had mentioned before eBay being a professional gap. I want to show you what I'm talking about. Look at this on the weekly pattern. First of all, look at this on the from the primary trend. Look at where it's held each time. We came down and held it basically to the tick, and then look at this pattern. This major engulfing pattern. So I often talk about a professional gap, and this is a textbook professional gap. Look at this. For days and weeks, this stock was coming down, looking pretty bearish here, right? Primary was a little bit lower, but wham, you gapped up above the downtrend line, engulfed multiple days, and then had continuation. So I would think that this is now a buy the dips type of stock if you get something that comes down. You just don't want to lose this 26.26 low. So if this kind of goes sideways for a few days or consolidates, you probably can play by the dips in eBay now. Looking pretty bullish actually. So let's go over to the indices, right? That's sort of what the major question is. And I had discussed that these lows I thought would hold. We had really good trade location here. You've had this big engulfing pattern, 95s, and there was a gap. I think this caught a lot of people off guard, and it went. I mentioned I think in the last week video that I thought that these really looked like they were forced. These days were declining, and you had a lot of people who were trying to short queued up at the 61.8 fib. What people didn't realize is we had hit it before, and a retest there. This really shouldn't have look this pulled back. It really shouldn't have been back up here again if it was going to be bearish. And it kind of backed off really mildly at these dojis, and it was just pulling back. It hit the 50, and then this gap caught a lot of people. It was a gap and go consolidation. This pulled back. It held right where it needed to, and then again, the same kind of thing. This just kind of caught people, stopped at the downtrend, and now today was a gap and go, and it closed above the old. This is absolutely amazing. If you look at this old up channel from the 2011 lows, you can see It held, and here we broke for the first time, consolidated, and now we're kind of like peeking back into the channel, which is really rather impressive action. Alrighty, let's get back into a normal time frame. So now the big question is going to be, was this a shooting star? And if we gap below the low here, are we going to just implode? I don't know the answer to that. I can just tell you this, though. This took back a lot of the damage. I mean, a lot of this damage here has now been taken back. This got kind of, if you notice back on my chart, I said caution if below 207.84. And then these were these 205.38 and 204.12. Look at this. We basically have been eating into these past reference levels. And then this one is another big one in the 207s. Look where the real bulk of this body comes into play. It starts here in the 207s and really picks up here up in the 208.97, which had been an old high way back in the day before we kind of just consolidated up here. So I do believe that after so many days up, like if there were another gap up on Monday, that could be maybe it for a little while. It would probably attract some sellers just because it's so extended. I mean, look at how steep this is getting. I do believe it's still possible. I know that this isn't a consensus idea, that maybe the highs for the year aren't in, and maybe there is some type of just a blow off top. It's possible. We'll see how it happens. So there's supposed to be about a $3 move next week. We closed today at 207, so 210 maybe. That would be like the 20, I guess, like close to the 2100 in the ES. That was a really big level. So maybe if we move up there, there's some interested sellers. If there's a pullback, we'll probably fill this gap up here pretty quickly. If this bar here, I would say that this big emotion bar, this big breakout bar here, this range is really important. If you can stay above that range in the 205s, I think the market is still pretty bullish. If you start dipping into this range and it gets a little bit iffy, with really the 204s here as the absolute must hold. If that breaks, I think we have the potential of traversing a lot lower, maybe to the low of this bar, and if that were to snap, then I think that there could be even maybe a move to fill the gap here. That could be a major, major move. I don't know that that's going to happen, but I like to always say take it one level at a time. My biggest complaint is that a lot of people assume the move is going to happen immediately. They go, oh, we broke here, so we're immediately going to the 182s. No, there were the 187s, that were a key level there. That's where the bodies were, and that's sort of where I thought we would stop, and we did. A lot of people that's why these people got short. They were pressing here with bad trade location. If you look back on my stream, I said it's getting too pessimistic, and I think we're going to hold. And it was I guess kind of a ballsy call at the time, but it was really the right one. And now all these people, believe it or not, who were very pessimistic down here are all really chasing up here. So that's why I'm getting a little bit more concerned here. The risk reward is getting a little bit concerned. And I would think that there could be some kind of a pullback in a little bit. But, we did break the downtrend. This day here, immediately this day's range is going to be key. If we're over, the 207.95, we're probably going to press higher. If we're, like I had said, on the, this is all just levels. I had said 205s were key. If we break 205s, we're going to 207s, and look where we went. So now if we break 207s, we're probably going to see 210s. So if you break, and on the contrary, if you break the 206 low, you're probably going to come back and maybe retest the 204s, which was really where this breakout was, 203, 204. See, that to me is like kind of how the range is going to be for next week. That would also be midway of the breakout bar here. It would be back below the downtrend, which would be a little bit iffy. And I don't mean to really cuff it on this, but, it's just all levels. I try not to think about it as much. I just kind of go by the numbers. If you kind of paint by the numbers, that's really how the market works. So a little bit of caution if we still press a little bit higher, particularly if it's in gap fashion close to these 209s, 210s. If we pull back here, I would be looking for, the 204, 205. That is really the must hold. If we break that, we're out of the upper distribution again, and then we, could have a risk of real collapse. Like we kind of went into here, stalled, and then, came back down. So that's SPY. Sorry to spend so much time on it, but that's really, SPY really is the market. All right, so this was why I had said that I wasn't as bearish on the market as a lot of people were. I want to just show you, look at this consolidation range, and look where the Q's kind of held. Besides the flash crash day, we didn't spend a lot of time below there, and we had been in that range for a very long time, and we broke the downtrend a while ago, and we are now back up basically almost to the all-time highs here. This could be a shooting star. If we gap below here on Monday, that could get a little bit iffy to fill this gap rather quickly, like we could come down, but and it would be a lower high. But Amazon and Google, they really powered this move here. Even Apple kind of started getting the Momo going. And keep this in mind, we've had a lot of relative weakness in some of the older tech, like the IBMs. IBM just absolutely imploded this week. I mean, look at this. And the market, this is the biggest weighted Dow stock, and this couldn't take the market down. If that can't do it, I don't know what can. But let's take a look quickly at the momentum stocks. Let's start off with Apple. I had said that I thought that the play here, someone had asked me on the stream what the play was. I said it's long above 109, and it's kind of shorter out below 109, and we've been above there. And I had said that I thought we would see 115s. If 115s held, we would see maybe 119s to 120s, and that's really been how it's worked. However, this has been the kind of the top range. See, there was a high here. This was really where the breakdown took place. So I would be a little bit cautious if we come up into here. There's a 200 MA around 121. So I would be a little bit cautious if we come up into there. Apple, when it's run into earnings, has been a problem. Look here, multiple days up, fell out of bed on earnings. Again, the same thing here, multiple day ups, fell out of bed on earnings. However, when you had the shake and bake, like a few days up and a down move ahead of it, that's when the gap, that's kind of when the magic happened, right? Show me the magic. That's when it took off. So I would really, if I had my druthers with Apple, I'd love to see like a panicky washout, like this kind of a move to play long. If we rally up into the numbers, I'm going to be a little bit more cautious. That worked like it worked for Amazon. Look at this. You had a run up into the numbers, a very minor pullback, and then it was a gap. But look what people used. Because they rallied up into the numbers, they used this gap to sell. I know a lot of people played this long. I was actually amazed at how many chasers were rewarded on this. The same thing with Google. I'll show you with that. But again, this was all used to sell. The same thing kind of happened here. Look, it ran up the last time into the numbers, and then it got, it held for a couple of days. The first day actually was bullish. The next few days were bullish, but then it sold off. Tried to rally up again on the Alphabet split, and then it eventually filled the gap. So I think that's what I think this was. Just like a lot of people who had bought it up here, they used this to take profits. So I would be a little bit cautious if you're chasing these. I would think that eventually, I mean, these patterns are really, really bullish. These are all-time highs, but I would be, if you've run up into the number, you got to use that gap to sell. I believe that also what had happened the last time, by the way, congratulations to anyone who had Facebook. I was a true believer in this stock for a very, very long time, and I was talking about this stock getting to $100 a really, really, really long time ago, and it definitely had its trials and tribulations over the last year or so, and today was vindication day. We got over $100, so congratulations. I'm glad this trade worked out. I know a lot of you have been in this trade. I know a lot of you had a lot of faith in me and my analysis with this stock, and you were really rewarded today for your, for your loyalty. So where does that leave us now, though? If you are first new to Facebook, or if you are, have been in it for a while. So I want to show you some things here and give you some levels that I see as being very important. And this was the last time Facebook ran up. This was on Google's earnings the last time as well. They ran ahead of this was on it. They ran ahead of their numbers, based on the Google earnings, but it then eventually kind of fell out of bed. It was just sort of listing sideways. This to me was a really kind of bullish consolidation, but then we had the flash crash in the market. However, Facebook has had a lot of relative strength in the market. The market isn't back to all-time highs, and today Facebook made all-time highs. A couple of things, though, we're a little overbought on the stochastics. If you look on, let me bring you into modern times. There are a couple of things that concern me, but before we go into modern times, let's go into the 2 years. There is, let me go even longer. Let's just do 5-year weekly. This line here has been sort of from the big gap, this was sort of the aha moment when Facebook became profitable. There has been a trend line. I've been using it as sort of a regression line, and when you're on the back side of it, the stock is too cheap, but when you're on the other side of it, it's maybe a little bit too expensive. And we are coming to the backside of that trend line now. Now let's go modern day. So how high can Facebook go? All right, we're rallying ahead of the print on Google again. We have that trend line coming up here around, if it were to happen Monday, it's like 104, 105. And then you have a channel high if you if you draw it from this low here, from this pullback low, excluding the flash crash into here, and you draw it from here, we're above the channel. And if you draw it from this high, that high comes in close into the 106s. If you do a Fibonacci extension and you do it from here to this low, excluding the flash crash day, that gives you a price target of 109.29. If you include the flash crash low, that gives you a price target of 116.07. Holy cow, wouldn't that be something? So I don't know I think we're going there eventually. I just don't know that it's going to be immediately. This does look like it's going to kind of get steep and get a little bit parabolic. So if we do rally the next couple of days, start looking to take some profits up into this danger zone, as I would call it, kind of like where we know there's going to be some reference issues from some longer term technicals. If you're not following me, you probably don't even know about this stuff. It's really worked exceptionally well for us up here. I had mentioned it back up on these highs, and it took a little while, but it worked. So I would be looking to either sell some out of the money calls or buy some put protection, or even just outright lighten up as we start getting up into these levels, just because we've run so much. But now I will show you this, the 99 here, close up here, the 98.74. Up here, this initially backed off. So 99s now should be support if we do wind up pulling back. If they are not, and it breaks, where would we be looking for the stock to go? The answer would be mid-range. What is that range? 86 here was the high. 99 here was this high. Mid-range is in the 92s. That was also the gap low from here. So I would think, and also the edge of this volume distribution. Look where the volume profile picks up here. It's like roughly around the 92 area. It's also a 50-day moving average around 92. So if this does wind up pulling back, this would be the first part, and then maybe the channel low around the 88s. Kind of these pullback lows could potentially catch it if there's some kind of a blow up. Maybe they have some bad bad numbers. Like we saw what happened with Skechers. There was a really big pullback. Maybe there's an outside move, but like I said, I just get cautious when we run into numbers. So just don't be too greedy. But those are now the key levels that I see. We all know these lower to mid 80s were supports and resistances before. If we got back down into there, I would think that it would be also, but we have now broken range to the upside, so mid-range now should, quote-unquote, should be support. Somewhere between around this 92 area should be the new support if there is a pullback to test into the range. That's Facebook. All right, so I'm going to have to eat a little bit of crow on Microsoft. It's not that I was wrong, that I was bearish on the stock, although I have been saying for a while that I thought Google really was eating their lunch, that they weren't innovating, and that the stock really, I didn't really see the reason for it being so high, although I didn't say it was a short, but I wasn't really bullish on it. So it's kind of hard for me to say that I'm bullish now, but look at this. It had a long consolidation period. It has now broken out of range. The stock looks bullish to me. I mean, it's obviously bullish. I mean, look at this. But I can't countenance first buying it here. I mean, if you go back in the Wayback Machine, sort of like Bill and Ted Excellent Adventure style, this was the peak of Microsoft in like the .com bubble days. So it is possible that this now wants to come up here and retest the old all-time high here. There might be some type of a Fibonacci extension. I'll discuss that if it becomes relevant. But it is possible that this stock wants to go a little bit higher and retest up there. Look, if you draw a channel from here, that roughly takes you up to the highs here. So it really would not shock me to see Microsoft continue still higher. It broke this pattern. The pattern is bullish. I'm just sort of bummed that I wasn't involved with the stock. You know, you can't catch them all. I always say you can't play all of them, but this one would have for sure been nice to catch. So what is the problem? The problem is IWM. This has had a lot of really relative weakness, these small caps. We could see we made a lower low here. It's sort of just muddling around underneath the upper, not even into the next distribution, below, just sort of like the very low end of the upper area. If you've been following me for a while, 117.37 was a really key level before. 120.58 was key. We are below all of those, and we're just in a sideways consolidation. It did break the down channel, which is good, or I should say the downtrend, which is good, but it hasn't broken out of range, and this could, if this really starts falling out of bed, could be like a fly in the ointment for the rest of the stocks. If there was some type of a gap up here, or this broke out of range, then I think that would be sort of the maybe a rotation into these small caps, and that could get the kind of the ball rolling. I think what's been really dogging this is that about 16% of the index is made up of biotech stocks, and that has been the smaller biotechs, like the kinds that are down 30 and 40% overnight. And I think that's been really dogging this and holding this index back. So if there's anything to really be worried about, it is the IWM. What was I going to show you? All right, let's move on. FireEye. So this FireEye is, as opposed to that FireEye, this FireEye is coming into some reference support. You can see these like 24s, 25s have been key. The 27s here were really a key level, 27 half-ish. We are below the flash crash low. We're kind of below that low. I think that if we came back down into here again, this would find some support. It might want to knife through and kind of do a shake and bake. But look at this. This has been a really protracted down move already. A lot of the selling pressure is, I think, getting used up. I think that selling some out of the money puts might be okay as a long proxy, but we have definitely transitioned from bullish to being bearish. And there could be some move down into the lower channel, believe it or not, even down to $20. That's the lower end of the channel. So I'm just a little bit careful with FireEye. One of the things that also has me really worried about this space, this is starting to feel, cybersecurity is starting to feel to me like sort of like 3D printing felt before it just fell off the face of the earth. Look at this. This has been a really protracted move. These things have been down ginormously. I'm going to go back to Palo Alto in a minute because there's some key levels in there. But look at this. This has like come back the entire move. If this could get back down here, the SSYS, back down to like close to $18, I think I would take a long, to give it a right out try, because it took back the entire move of the run. So down here, believe it or not, I'm starting, maybe we don't even see it because look at this. It gapped and it rallied. So maybe this was it, right? Like you kind of just barely undercut here and it's kind of bouncing up. But Palo Alto, look at this. This is a head and shoulders pattern. I was thinking maybe it was going to be an inverse head and shoulders, but this neckline is starting to break. You're starting to break the secondary trend here. Let's go out in a little bit longer on a weekly chart. You can see the primary trend is all the way down here. The secondary trend, which has really been the run, is now for the first time starting to break. You have a 50-week moving average down here. This held before. We'll see if it holds again. But if that snaps, man, I think this is getting ugly. I'm really cautious below 167.82. I think that the play, I mean, it's down a lot, but I still think the play here could be short. We could, the earnings aren't for a while, so it might not really snap just yet, but it could just meander for a while. But as long as you're below this 167.82, I think that the pattern is still to the downside. It's a little bit risky. It could retest here. The 50-day moving average for a very long time, you can see here, held it. It tried getting back over, and now it's sort of been resistance. So as long as you're below the 50 in this, and this neckline, I am really, really cautious, and I would be very careful if you're still long these stocks. So that's sort of my story with them. Netflix. This is really getting me a little bit frustrated because I've been really looking for an opportunity either to bang this thing out short or to play it again long. I haven't been involved in the stock for a little bit for the last week or so. Anyway, I had said that I thought that a break of the 103.88 would be bearish. I was short this day. I think I was short from 105 and I covered in the 93s. You can see it's just then I had discussed back up here, this could potentially be a short back to form the head and shoulders, which it did, came down, and then it kind of rallied up more than it should have. I said 115. If you go back this day and you look, I took a lot of heat on this. I said 115 with maybe some slippage to 119 was the sell. It was correct. We are now just banging around in range. So this could just consolidate, believe it or not, and work off a lot of this excess more than by time than price. But we are in a bit of a down channel. I drew it in a couple of different ways. The after hours low when it dumped on earnings was 93.55. I thought that would retest a little bit quicker. I also thought this 85 would retest, and maybe even the 70, which was really the breakout. We'll see what happens with this. It closed today basically at 100. This is the meat of the move, so I'm just kind of waiting for it to show its hand. I would be into playing this with either put ratios for a move lower or some call ratios for a move back higher, like for a gap fill play, maybe being long, 105s and then short 2 times like the 105s, 107s. Maybe long like the 105s, short 2 times the 110s for the gap fill. Gap fills from earnings seem to be resistance, so that would be like the up move there, and then maybe flip and play it short, or if there's a move down, to get long down here. So I would like playing this with both call and put ratios. Alrighty, price line. This has rallied up. This was really powerful. It looks like it has a bit of a double top going here. It's just chopping sideways. Their earnings are coming up. This is probably going to be a ginormous move. If it follows the Facebook and the Google and the Amazon, the move will be higher. There is some room to a channel high. I said in the last video, actually, that I thought we were actually in a big channel, and you can see that is actually where I think that's winding up to be true, but that we are getting a little bit close to the upside of that channel up into the 1400s, which would be a move above the old high. But if there is a gap there, I'll show you the last time what happened, that this had run up a lot ahead of earnings. Look, deja vu all over again. Ran up, then gapped like $100 on earnings, and then proceeded to completely sell off to the backside of the down channel. Maybe lightning strikes twice, and there's a gap to the upside of the channel, and then it immediately sells off to the downside of the channel. So maybe we get them coming and going. I'll discuss that a little bit more with some trade ideas as we get closer to the earnings. If you have a smaller account, don't mess around with this thing. You can really blow yourself up. I mean, it's a $1,300 stock. Be nice if they split this damn thing already, like 10 for 1, and made it a $139 stock. So maybe some of us peon retail traders could trade this thing a little bit more easily. Anyway, that's the story with that. So Tesla, I had talked about up here this being a bit of a sell. I tweeted out that I thought that this was going to come under pressure because of the Ferrari IPO. And wow, did it. We are back now into trend support areas, also near these lows. I think somewhere between this 181 and 195 maybe. Somewhere in this pocket. I know it's wide. I think with the gap fill being 191, I think down here, if there's some weakness ahead of the print, it could be a long for earnings. Or if it rallies up ahead, then it gets a little bit iffy. But I would love for this to come down a little bit further, particularly since it's all in one leg, and to really create some panic and then get the IV jacked up and then sell some puts and that, or play long for the stock. If it rallies up ahead of time, let's be a little bit careful. I had said that the 242 number, that's where Elon Musk did the secondary, and he bought into that. This gap fill here to me would be one between the 242 and 246. That's going to be some resistance. Look where these lows were. That's sort of like midway here, and where this high was. I think that will be the resistance on the upside. That said, we are getting a really kind of bombed out in the stochastics, and I think that put ratios may be more, not so much to be bearish, but to kind of play for a little bit of a move down would be kind of the good play. Ferrari came public, and it really was, let's see, let's use 10 days. I guess I have to kind of use 1 month daily. All right. Anyway, the high of the day there was like $60, a little under 61. The low was 55. So if you can clear the 61, then the stock is probably going to run. This is not a cheap stock by any means. It's trading really pretty expensive. I think like 30 times earnings, and they only have like 4% growth or something. They have a lot of stock coming on to the market in January. So if you're bullish on race, it might be a 2016 story after that extra supply comes on. That's my thoughts. And I'll end on WYNN. This stock, I had said that that there was a move in the range, that I thought that there could be a pullback to the 61.8 into 61s. That wound up being the low. You had a gap and go a bit today. If you start losing more than the 63, which is the kind of the top here, I would say GTFO, it's going to be pulled back too much, but there is a potential that it moves up to the 70. And I actually believe that this stock at some point is going to see the $100 mark again. I don't know when. That was really kind of where this big breakdown took place. It was a 61.8 for a while. So maybe this does want to rally up here at some point. But 61 and 63 were the key levels, and I would use the 63 here if it breaks there as the stop. Anyhow, if you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you like this video, hit the like button. Be sure to subscribe. There's a subscribe button. You'll get weekend review video updates. You'll get Periscope rebroadcasts and special edition videos. Anyhow, let's have a great weekend, and cheers.